Well, hello, welcome to Markets 101. Today we're going to talk about the foreign exchange basics. I remember before I got into the world of being a trader, before I got into the world of Forex especially, I remember this being such a strange thing. Such a strange thing. I remember when I was 15, we went to Mexico. And it was the first time I'd ever been out of the country. And I remember the first time seeing and using different monies. And I remember at the time the peso was 6-1 to the dollar. And I remember asking my dad, well, who decided that? Who decided that? And my dad, he didn't know. He's like, I don't know, that's just what it is. And that's just how it works for most people. So I wanted to get into Forex, what it is, how does it work, and how in the world do currencies change values? So we have to answer the question, what is Forex? And Forex is short for foreign exchange. Sometimes you'll just see it listed as FX. But foreign exchange, and this is basically the mechanism where people can change currencies from one to the other. Now, there is a marketplace for this. We're going to talk about that marketplace later. But in this marketplace, you can actually trade dollars for euros. You can trade euros for Swiss francs. You can trade Swiss francs for Australian dollars. And it's this marketplace and this exchange that allows people to travel. It allows businesses to invest in countries that aren't their countries. And so this marketplace is a huge, huge marketplace. And it's something that the rest of the world understands very, very well. Here in the United States, we don't understand it as well because, when you were in Europe, well, now that there's the euro, there's not such a big deal. But back in the day, before the euro, you might travel to 2 or 3 countries in a week and have to constantly be changing money back and forth. And you probably had money sitting in your desk drawer for next time you went to Switzerland because you go there every couple of weeks. It's something that people aren't a lot of times familiar with. So let's cover exactly how this whole thing works. Now, the first thing that we have to understand is that your paper money is a fiat currency. And let me tell you what I mean by a fiat currency. A fiat currency is a currency that is not backed by anything of actual value. Now, when currency very first started out back in the 1600s, it actually started in the Netherlands, and it started as banknotes. So what would happen is if you had a large amount of money in a bank and you wanted to buy something in Germany, the way you had to do it back then is you had to load up your horse. You had to go to the bank. You had to get like a couple thousand gold coins. You'd put it in a chest. You'd put it in your wagon. And then you'd have to hire a bunch of armed guards because you were a target. And if the bandits got you, you lost your money. And if you got there, you could then give your big chest of gold over to the party you were trying to get it to. Well, in the Netherlands, they decided to do banknotes, where you could actually take a note from your bank, and you could give it to another bank, and then that bank would facilitate that transfer. And they would do it because they were much better at transporting it. They already had a whole bunch of armed guards. They were there. So that is the start of banknotes. And when countries started issuing notes, they actually started issuing notes based on how much gold and silver they had. So the rule was that if you wanted to make more currency, you had to have more gold and silver. And if you go back into, I think, pre-1950, there were what were called blue and red notes, where there were actually blue and red seals on U.S. currency. And if you had one of these notes, you could actually go into a bank or go to the government and actually get that value worth of gold or silver. So if you had a blue one, that was a silver note. If you had a blue silver note, a $20 note, you could take it in and get $20 worth of silver. So that currency had value. In the 1930s, everyone pretty much abandoned the gold standard, and now that all currencies are literally figments of your imagination. They aren't worth anything. And take out any currency and hold it up, and you can see it's a piece of paper. If you tried to go pay for something with a piece of paper, they would tell you to get out, you're crazy. So the question is, where is the value? And the value is now what's called perceived value, a fiat currency. And let me give you one little story about a fiat currency. As you can see here, we have a $100 trillion note from the Reserve Bank of Zimbabwe. Now, I actually own one of these. So yes, I am a 100 trillionaire. Yes, to pat myself on the back. I bought it off of eBay for about $7 is what I bought it for. So I guess it's worth about $7. Zimbabwe actually had some political unrest, and the government decided that they were in debt, so why don't we just print more money to get out of debt? Oh my gosh, what a great idea. So they printed more money. What happened is that caused the value of the money to go down, and at some point, the currency wasn't worth anything, and even this $100 trillion note was worth nothing. One of my favorite stories that I heard was in Zimbabwe. There was a man walking down the street with a wheelbarrow full of money, and again, these big stacks and bricks of cash and money. And he was walking down the street, and two guys ran out from behind one of the houses, pushed the guy to the ground, knocked him down, grabbed the wheelbarrow, dumped out all of the money, and then ran off with the wheelbarrow. Now, I love that story because it goes to show you that the value was the wheelbarrow. There was zero value in that money. So, in order to really understand how currency values work, we have to really start with the understanding that the value is perceived value. The perceived value is what everyone thinks about it. Now, there are lots of things that are going to affect the value and affect the perception. But in the end, it's basically going to be perceived value. So with this in mind, now it's a lot easier to understand, why do currencies change in value? Well, they change in value because people's perception of the country, of that country's central bank, of that country's banking system has either become better or worse. And so the Forex marketplace determines that. It actually determines that. It's every single marketplace, the New York Stock Exchange, the Forex marketplace, the London Stock Exchange, it is a mechanism to determining the true value of things. And so you have a place where buyers and sellers come together, and they basically will bet, and they'll exchange these assets in exchange for monies, and basically it will set the value. So again, these currencies are constantly moving up and down against each other. And like I said, there is lots of things that go into why they change, but they change because of the perceived value of that currency. So let's kind of go through an example that most people can understand about foreign exchange. And again, when I was 15, the very first time I went to Mexico, I experienced this where we went on a trip. We went to a currency exchange place, probably in the airport. So you walk up to that, and let's say I wanted to get 100 euros for a trip to Paris. Well, the exchange rate was 112 US dollars to 100 euros. Now remember, I asked a question to my dad, why is the exchange rate 6-1 for the Mexican peso? My dad didn't know. The answer to that question was, that was the market price. That was a market price that the market determined at that time. So in this example, to get 100 euros, you needed 112 US dollars. So you had a great time in Paris, but you actually put everything on a credit card, so when it's time to come home, you still had your 100 euros. So you walked back to the currency exchange place, and you said, I would like to have my $112 back. The problem is, they only gave you $110 back. Question is, what happened? Well, the answer to that is the currency value changed. When we left, we paid 112 US dollars to receive 100 euros. The exchange rate was 112 to 1. When we returned, the exchange rate was 110 to 1. So what happened was, during that period of time, the euro declined in value against the dollar. So again, the euro declined in value against the dollar. Basically, this was a losing currency trade. This is a losing currency trade where, hey, you know what? You bought euros, you held euros, you turned around and converted them back to dollars, and during that period of time, the exchange rate went against you. It went down in value, and so you actually lost money. Now, of course, this could have easily gone the other way. You could have left, and with your 100 euros, you could come back and you might have gotten $120 back if the exchange rate went to 110 to 1. So again, this is where these are always changing values. So the Forex marketplace is this huge global network where, again, people come together to trade these currencies. And these currency values are constantly changing all the time, every single second of the day. They're changing and changing. Now, they're going to make big changes based on capital flows around the world. For example, when Europe was on the brink of failure in 2012 and 13, and people were worried about banks and their solvency, what do you think happened to the euro? The euro declined in value because there was a flow of money out of Europe, and they were going to safer places. Once Europe became more stable, what happened? Well, the money came back in, and you saw a surge in the euro. So that is basically wraps up what is foreign exchange, how it works. Now at this point, it's all a matter of how do we actually make money in the marketplace by using these exchange rates.